This is Dr. Meenu Balian, Assistant Professor, IMS Engineering College, Ghaziabad. The topic which I am going to cover is Indian financial system. In the previous class, we have discussed about the components of Indian financial system. I am just giving a recap of that. We talked about the Indian financial system. Indian financial system actually having the banking institutions and non-banking institutions. Now moving further, now in this lecture we will cover the rest three components. One is the financial market. What is financial market? It is divided like organized and unorganized, means having some rules and regulation in the organized financial market, and the unorganized means there are some people who are making their own rules, but they are not governed by the government. So, moving further, financial market, actually the market is a place where buyers and sellers meet together and they actually perform the transaction. What kind of transaction? Monetary transaction, means they are exchanging their commodities, they are exchanging the money, and people are some are receiving the money and some are making the payment. So, in short, financial market where buyers and the sellers interact with each other and they participate in the trading of money, bonds, share and the other financial assets. Financial market can be further divided like this. There is a capital market, money market, in foreign exchange market and the credit market. What is these market? Actually these markets are divided on the basis of the requirement of the funds. When you need long term, when you need short term funding, when you are looking for the foreign exchange and we are looking the loan. So, on the basis of these requirement, the financial market has been divided. First we will be talking about the capital market. What is the capital market? It is designed to the finance of the long term investment, and the capital market deals with the transaction with the taking place in the market over an year. Over an year means more than 1 year, more than 365 days. When the transaction is less than 1 year means it is 364 days, maybe quarterly, maybe on the daily basis, or maybe on the 14 days basis, maybe on the 3 months or on the basis of half yearly. So, it comes under the short term requirement of the funding. So, here we will talk about the long term financing, long term requirement of the financial assistance. Capital market deals in this long term financial assistance. So, this market can be further divided on the basis of corporate securities market, second is the government securities market, and the last one is the long term loan of the long term loan market. So, what it is? When we talk about the corporate securities market, the term itself clearing itself that this is the securities are being traded in this. Securities mean your stocks, your bonds, your shares and all. So, corporate securities are equities and preference shares, debentures and bonds of the companies. Now, there are equity shares and the preference share. I suppose this thing is clear to you, but I will explain again. The equity share are the shares. Actually, when the person taking the equity share, the company issue the share and the shareholders taking the equity shares, purchasing these shares, that become a part of the company and they get the chance of the ownership also. They having the voting rights of also in the, and they attend the board of director meetings. So, when we talk about the equity share, when they are the owner of the, when they having the ownership in the firm, it means the liability of profit and loss distribution is on their shoulder. So, if the people get the profit, then it will they will be the last person who receive the part of the profit, and if the people have the company is facing the loss, they would be the people who have to suffer the losses, and they people are supposed to compromise with their profit all that time. Now, coming to the moving further, these are the preference share. Preference share, the name suggests itself, these are the shares which actually get the preference at the time of the division of the profit. They get a dividend on the predetermined rates. So, there is no point of they will not face the losses because they are not a part of the company, they just having the preference in terms of the profit, they receive their dividend as the company get the profit. If the company is facing losses, though they people will get the same amount, same predetermined amount at the time of the this redemption of the share and at the time of the after 1 year. So, there are bonds and debentures. Debentures and bonds are kind of loans, long term loans, which company need at the time of financial assistance. When the people are looking financial assistance, that time company issue the debentures and the bonds to the public, and on this is a type of loan. On this debentures and bonds, company give the interest amount as a return. So, on the shares investors get the dividend, and on the bonds and debenture people investor will get the interest. Now, moving further, the corporate security market is very sensitive, and it is based on the current market situation directly related with the economy, and if there is any fluctuation in the stock market, the value of the share and value of the debenture will definitely go up or will go down as per the economic conditions. So, there are the second one is the government security market. What is the government security market? The government is there, means some security is there. So, government security in this market, government securities are bought and sold. The securities are issued in the form of bonds and credit notes, but these are the secure loans, secure securities, because governments are associated with them and government is making the rules and regulation for them. So, the buyer of the such securities are banks, insurance companies, provident funds and RBI and the individuals. Who are the buyers who purchase the government securities? RBI itself purchase the security, this provident fund and insurance companies, and one is the security which is the purchased by the government. Third point is coming long term loans of the market. What is the long term? I told you that long term means more than 365 days. Banks and the financial institutions that provided long term loans firms for the modernization, expansion and the diversification. See, there are three things in this definition. That one is the modernization. Modernization means when you are looking for your business to have some modernization, you want to update your technology, you want to update your business in the according to the current situation. In that situation, you are supposed to have some finances, because when you are looking for updation in the technology, that need money, and for this money we people will look for the long term requirement of the fund, because this technology will go on and on. So, at the time of the modernization we look for the long term loan. Second one is the expansion. When any business is looking for any kind of expansion, means suppose a business having one branch and the business want to have more branches or want to expand their business. When the expansion is there, that time the requirement of long term loans arise. Diversification means you are producing one commodity and now you are producing 2, 3, 4 more commodities. The diversification is there, and you want to it is also a expansion kind of thing, but it is there is branches are not same, the production is different and the product will be different. That is the diversification, because the company is looking for the product, they are diversifying their product according to the requirement of the market. So, these 3 points means when you having the requirement of diversification, expansion and this modernization, that time we require the long term loan. Long term loans market can be divided in terms of the loan market, mortgage market and the financial guarantee market. This is some examples of the long term loan market. Moving further, now second comes the foreign exchange market. The terms itself say the foreign exchange means what? Foreign exchange, currencies of the foreign. When you required money, when you are importing, when you are doing export, there is a common currency called dollar. That time you are supposed to pay in that common currency. So, that time you required foreign exchange department or foreign exchange to actually execute your this requirement. So, this foreign exchange one of the most developed market across the world. The foreign exchange market deals in the requirement related with the multi currency. What is multi currency? When you are exchanging your currency, maybe pound, maybe yen, maybe in dollar, that time you look for the market where you can easily exchange your currency and actually perform that execute that transaction. The transfer of funds in this market takes place based on the foreign currency rate. It is totally up to the current market situation. Whatever the ratio of the rupee and the dollar is that will be determined by the current situation, and these relation is daily changing. On current rate we take the like daily changing process, means today rate will not be same tomorrow, and tomorrow will not be same as day after tomorrow. So, it works as the current price. Moving to the money market. Money market is a market where you actually banks provide, this institutions provide the short term funding. Short term funding, I told you that the market which is fulfilling your requirement of the short term period, means less than 1 year. So, the money market actually can be explained, this is the market where it is authorized for the short term investment. The money market only can provide the short term funding, they cannot provide the long term funding. For long term, capital market is being there. So, it is the wholesale market, debt market, and which work for the low risk and high liquidity. What is this low risk and high liquidity? Means it is secure, it is governed by the government, and it is why it is low risk, because on the daily basis or on the basis of 14 days you are raising the funds, and these are the called secured loans. And on the high liquidity, whenever you feel like, if you need money today, you can take money today. If you need money for 14 days, you can raise money for 14 days. If you are requiring for 3 months, you can raise funds for 3 months, and if you are looking for the 6 months or less than 1 year, you can raise this financial assistance according to your requirement. That is why it is called most liquid. So, instruments are, these instruments actually provide the low risk and the high liquidity. The money market is divided like organized market, and other is the unorganized market. What is organized? The term itself explains that there are some guidelines governed by the government which people are supposed to follow, and in our unorganized, they make their own rules, they treat their own interest according to them, whatever the condition is. So, some examples of the organized market is treasury bills, commercial paper, certificates of deposit, call money market, commercial bills market. These are the organized market, and it works as per the rules and regulation governed by the RBI. RBI is what? Bankers of banks, means Central Bank of India, the Reserve Bank of India, which make the guidelines, which protect the customers or the clients' interest. So, they are governed by the RBI. RBI control the organization in the financial market in India. RBI is the regulatory authority. In the previous lecture, I also explained this thing. RBI governed the RBI having the right to give the feedback, to give the strategies to make the regulations for the banking sector. Now, moving further, we have unorganized market. Unorganized market having some examples like money lenders, indigenous bankers, and the chit funds. These are the unorganized way to collect the fund. There are no such SS guidelines governed by the RBI. So, moving to these are the continuation part of this financial market. Fourth one is the capital, this credit market. What is credit market? This term define itself that the credit market, when you having the short term and long term requirement. So, this is being guaranteed to the individual or organization, or maybe to various bank and the financial and non-financial institution. These called the credit market. What is, I again explain this, they are giving the short term and the long term loan they are providing, and they provide it to the individual and to the organization, and these loans are given by the various banks. Banks may be private bank or it may be public bank. And there are financial and non-financial institutions which is known as the credit market. Financial market are and the non-financial market are where you do not do the transaction of accepting the deposit, but you having the target for providing the fund to the public. Now, coming to the next part, this financial services. What is the financial services? Actually, there are n number of services being provided by the in these financial institutions by the banks and all. So, we will discuss about these financial services. Financial services concerned with the design and delivery of the financial instrument. What are the instrument? We will next topic we will study about these instruments. Basically, these instruments are long term instruments and the short term instruments. Long term instruments are like shares, your debentures and your bonds. In the short term, there are treasury bills, there is CDs and the certificate of deposit, there are term loans, there are call money market. These all are the short term markets or instrument. Advisory services which provide the advice for the investment. There are n number of advisory services, advisory organization with whom you can take the advice for your investment, and they will guide you according to your financial background. To the individual and to the business itself, the area of banking and related institutions, personal financial planning, leasing, investment assets and the insurance. These are the some examples of the financial services. Now, again we will go up here, they are meeting the requirement of the individuals and the businesses requirement, or any firm or any organization when need the long term short term funds, they can actually take the advantage from this financial services. This is cover the area of the banking and related institutions. This personal financial planning is there. Personal financial planning means you are making your portfolio according to your funds, means whatever funds you having in your pocket, that tell you about the investment according to your financial ability. Some examples of this financial services is leasing. Leasing is a process where actually you can take the lease of land, you can take the lease of building for long year of duration, and in that you can perform your task, you can set up your business and all. Investment assets and insurance. Insurance are, you are taking the insurance for covering your risk of accident, your risk of the what you call it, risk for the uncertainty. Uncertainty, I told you that uncertainty means that there is a risk for that things will not happen in the same way which you are expecting, and this investment is totally uncertain thing because you never know what will happen tomorrow. So, it is always a good thing to take the precaution for that, what will be the future tomorrow. There are some services which are being provided by the financial system. One is the banking services, one is the foreign exchange services, other is the investment service, and last one is the insurance service. Banking service means you are accepting the deposits, accepting the deposits, and you are getting benefit of ATM, mobile banking, and your net banking, these are the services which is done by the banking sector. In whatever branch or in whichever branch you have your account, you can take the advantage of these facility by just opening your account. When you open your account in that branch, they will give you your mobile access, your email address, email access. You can secure your account by the OTP, one time password, and all these facilities making the secure investment and making your money secure. So, bank is giving such services to make your investment, to make your savings safe. And now, second, coming to the foreign exchange market. What is the foreign exchange services? Means in the foreign exchange market, you are exchanging your currency in terms of wherever you are going or wherever you are dealing. Means if you are going abroad, or you are exchanging your currency according to that only. The investment services, by the investment services you are getting the benefit to invest your money into the different sectors. You can make your portfolio and you can diversify your risk according to your financial capability. You can choose the high risk, you can choose the low risk, or you can choose the moderate risk. It is totally up to you that if you are risk averse, if you are risk taker, or if you are having the moderate kind of risk capability, you can choose according to that only. So, insurance services is what? Insurance services means when you are insuring your business, when you are insuring yourself. In the insurance, we talk about the life insurance and the general insurance. What is the life insurance? Means you are saving your life by the insurance, by the medical insurance, by the accidental insurance. You are saving your life, you are taking the medical policies for the future. If anything happens to you, your nominees will get the money, and so that the people can survive after you. We can call the general insurance also, that is called the GIC. General insurance is what? When your marine insurance is there, your currency, your marine insurance is there, your vehicle insurance is there, house insurance is there, means you are securing your assets. Physical assets you are insuring. Now coming to the financial instrument. These are the instruments for which we are talking so far. Means in by these instruments you can actually do the transaction, you can raise the funds. In the financial institution, they are actually performing this task. Financial institutions work in the financial market, and the financial market provide the services, and they provide the services on the basis of these instruments. That is the way of the Indian financial system. This is the actually structure. Institutions work, the institution provide work as a moderator. These moderator having a market of primary market and the secondary market. This market actually having some services, and these services having some instruments. So we will talk about each and every instrument there. Now first one is the call money money. Call or notice money. The term itself clear this thing, that call means whenever you need money at a call. As we make a call, whenever you require money, suppose you require money today itself and by the end of day, so you can raise the money by these instruments. Actually the borrow on the demand for every short period, for very short period can be like 1 day. So when money is lent for a day, it is, you are keep asking money for a day, and it is known as the call money. When you require money, you ask money and you immediately call the money. So this financial instruments provide the facility to take the money for a very short period. The money is borrowed or lent for more than 1 day. When you suppose you exceed the day and you need this money, suppose you need money for 14 days, so that become the notice money. When you are asking money for 1 day, 1 day is your call money. When you are asking for the 14 days, that become the notice money. So this is known as the call money or the notice money. Term loan, this is the second instrument of the financial services which provide by the financial institutions. Deposits are maturity period, with the maturity period of beyond 14 days. See, this call money is for 1 day and this notice money is for the 14 day. When you exceed for more than 14 days, that become the term money. When you are exceeding it for the more than 2 weeks. Now coming to the treasury bills. Treasury bills are the short term instruments up to the 1 year, means less than 1 year you can raise the funds through the treasury bills. These treasury bills are the borrowing instruments of the union government, and it promised by the government to pay the stated sum after the expiry of the stated period from the date of issue. When you issue this treasury bills, these it start with the issue date and end up with the this mentioned time duration, and that mentioned time duration should be less than 1 year. Means if it exceed than 1 year, then it will not be treasury bill, it will become your long term funding, it will become long term funding. When you talk about the treasury bills, raising funds through the treasury bills, it is mandatory to take this loan only for the short term period. Now coming to the further instruments of this. This is the certificate of deposit. This is also called the COD. COD is a money market instrument issued in the dematerialized form as a promissory note. Promissory note means where two parties having a contract where one promised to pay that particular amount to the other person on a given specific time duration. So, the fund deposit at the bank, other eligible financial institutions for the specific period can take the advantage of this certificate of deposit. So, we can say that certificate, these all are the money market instrument. Money market basically deals in the short term funding. They provide the short term instruments for the short term funding, short term liquidity. So, this next coming to the commercial paper. What is the commercial paper? This commercial paper is actually it is a evidence of the debt obligation to the issuer. Means you are, this is a evidence, this is a proof that you will be giving that you are taking the debt and you will be returning it to the issuer. So, on issuing commercial paper, the debt is transformed into the instrument. When you are issuing this commercial paper to any party, that become the this debt will be transferred to that party, and by this you can take the advantage of short term funding. So, as a recap, we can call it that people discuss about the financial institutions. Financial institutions have financial system having 4 components. One is the financial institutions, second is financial market, third one is the financial services, and the last one is the financial instrument. So, if we talk about financial institutions, these are the mediator, or these are the person, these are the banks, actually basically these are the banks which facilitate the long term and short term funding requirement. And if we talk about the private banks are in the financial institutions, they work as a mediator. Commercial banks having the two type of partition, like one is the public bank and other one is the private bank, and these banks work for the society, work for the investors, work for the saver. They govern by they follow the guidelines provided by which is provided by the RBI, that is Central Bank of India, Reserve Bank of India, and they follow all the regulation, all the rules made by the RBI. Second, we were talking about the financial market. Financial market is what? Where you are doing the transaction for the short term and the long term. There is a 2 market, one is the capital market, other one is the money market. Capital market basically deals in the long term financial assistance, in which we have studied about the equity share, preference shares, debentures and the bonds, and these are the long type of financial assistance. Capital market again having 2 partition, like primary market and the secondary market. Primary market deals in the initial public offering, means issue the shares very first time, and in the secondary market we do have the existing share and the reissuance of the shares is being done in that way. So, the financial market, this capital market deals with the long term financing. In the money market, we talked about the short term requirement of the funds when company or when individual, when any person required the loan for the very short period, means less than 1 year. That time it is important to raise the fund through the money market, and you can raise the money through the money market. And the thing is that when we are talking about the this instrument, these all instrument which I have discussed comes under the money market, because these are the instruments which provide you the short term funding. If we talk about the long term funding, that there are shares, there are equity shares, preference shares, bonds and the debentures, which deals in the long term financing. So, students, for today I think it is you can take the help of the reference book, and you can write me also, you can ask your query to me also on at my email ID meenu.balyan@imsec.ac.in. If you feel any kind of query in this chapter, you can ask me. Thank you.